Our panelists, of course, need no introduction. Exactly to my left, we have Tina Byles Williams. She's the CEO and the CIO over at Xponance, and of course, Dan Chung, CEO and CIO over at Alger. And I think, you guys, when I was thinking about how to kick off this panel, I do want to say we are taking questions as well. We want to make sure that this panel is as fulfilling and rewarding for you all. So if you have questions, make sure to raise your hand and I'll make sure to jump those in as well. Before that, though, I do want to kick us off. And I think sort of the big theme that we've been talking about has been higher interest rates. Tina, we'll start with you. Sort of big question, how are you thinking about growth, especially if interest rates are going to continue to rise?
That the question? Or no, I'm just kidding. Who's thinking about interest rates or inflation? Anyway, look, it's the Fed has been flat-footed. You know, what someone said, they're sort of looking at the direction of their feet to figure out where to go. And so they're playing catch up. And you know, so there are a couple of things. One is, what is the neutral rate for the US? Mm-hmm. Because if the neutral rate is higher than what's discounted now, then, you know, we can actually tolerate more hikes. I actually think that the neutral rate is somewhere between, I don't know, 3%, which is much higher than currently thought about, and we can talk about that. But as it relates to this topic, obviously, you know, we have more to go, and it'll be a tough time for growth stocks because of the higher discount rate, you know, used for earnings. I know my friend over here will.
Yeah, Dan, weigh in. Do you agree? Are you looking at higher rates and the pressure that puts on long duration growth assets?
Well, we think that for growth assets, the first stage is already pretty much done, which is valuation compression. Now we're looking at, you know, across the market, value and growth, you know, earnings revisions probably downward into this recession. As to interest rates, I'm probably a little bit higher on the neutral rate, more like 3.5 to 4, but that's still below most of I think all of the decade of the 90s, which obviously was an extraordinary decade for equities, for growth. And I think I'm actually seeing a lot of the same things today still in the economy broadly. So
a lot of people would argue, though, that valuation compression is different. There's a structural difference this time because we're in a new structural regime. Do valuations then in the math and the relative value still work if you think we're in a just entirely structurally different environment?
I think as it relates to inflation, and we actually have a piece that's coming out this week, we are in an entirely structurally different environment. You know, the late Fed chairman, Paul Volcker, is sort of lionized as having single-handedly slayed inflation. And I think he did slay cyclical inflation, but what allowed his inflation fighting policies to endure for 30, 40 years had nothing to do with him, in the sense that, you know, it was globalization, it was glasnost, which opened up sort of labor supply. It was the fact that after the Cold War, you know, all this technology became, you know, available for commercialization, which led to a big spike in productivity. It was demographics. It was a lot of things that are outside of the purview of the Fed chairman. So the question I ask myself is, where are those things now? And I don't see them, I see them either reversing or not being important. And so, you know, the San Francisco Fed did a fantastic study of disaggregating cyclical from structural inflation. And, that the latter shows an increase, and I think it will be a sustained increase. So what does that mean? I think that, I actually think that when the Fed revises its model or evaluates its dogma in 2025, the 2% target will be on the table.
Do you agree?
I think the 2% target is too low. It's clearly incorrect. I think it's an artifact of the ever lower rates. And as I referenced, and we've had terrific periods of growth in the economy and in the stock market when the 90s, when 2% was actually, people were terrified of anything below 3%. People were worried about deflation, right? So stagnation. So I think that's right. It shouldn't be 2% they target. I think they're going to target 3, or I don't know, something like that. And my point is that the stock market, I think, is kind of well ahead of I think Tina and I both agree the stock market is well ahead of the Fed on several fronts on this.
Well, tips inflation break-evens are 2.3% on the 10-year.
Yeah, I think that's wrong.
Yeah.
You agree?
This is what makes markets though.
Right.
Okay, so the big question has been, have we started to see a bottoming out? Depending on where you think inflation is going, where we are in the environment, is the bottom getting close enough that you can start to dip your toes back in? How are you thinking about that question when it comes to growth stocks?
I'll go first.
So, I mean, we think about the history of market cycles for growth stocks, which is our specialty, and the market overall. And we typically see 3 stages, right? First stage is valuation correction, and it does hit the growth stocks the hardest, and that is always around a Fed rate cycle increase. So that total logical. We think we've gotten through actually most of that, and of course, potentially in some sectors like small cap growth may have overshot it. Second stage is recession, earnings revisions, negative. Earnings revisions in the S&P were still going up for the first half of this year. They've only just started to come down. They probably have quite a bit of ways to go. I see no way that Europe isn't going to impact S&P earnings. I'm surprised that probably a very hard recession in Europe hasn't been, more quickly filtered into S&P earnings. But as the earnings revisions start to get more negative, there is a pattern that we've seen historically, which is if you were to take sort of the growth stocks within the S&P and the value stocks within the S&P, you see more negative revisions among the value stocks, and that's largely just their sector exposure, right? Financials, cyclicals, industrials, old world retailing, fixed asset retailing versus, of course, in tech you have software, more healthcare, e-commerce, right? So you tend to see better earnings resilience among the growth side, more sensitivity to the economic downturn on the value side. So earnings revisions negative on both. And we may be already starting to see this. Actually, in the last 3 months, I believe value and growth is actually acting relatively the same, right? And so I think what will happen now is we'll see earnings revisions negative. I think it'll be harder on the cyclicals, or we've clearly seen companies with lots of debt. We try to avoid those in our investing philosophy, but companies that are very leveraged, or obviously market is very quickly pricing in, like when they need to refinance, how negative that's going to be an impact on there. So earnings revisions negative, growth we think will hold up better. And relative valuations have come in far enough. In small cap growth, I've already said it's historically low, and large cap growth actually as well on some metrics is looking like it's corrected enough relative to the market to essentially go with the market. And we think the next stage, third stage, is generally growth begins to outperform value.
So we're getting
as
closer.
You head into recovery. We think in time we're getting closer. The bear markets for growth stocks is really almost a year old now. We think towards the end of this year, I think December is going to be really interesting. I don't think much happens between now. I mean, a lot of volatility happens. I think no clear direction happens between now and December. But I think by the December Fed, we could get much more of a sense of how much do they really want to pause? They've talked about, holding for longer. If you look at the history of the Fed, they're very bad at actually holding for longer. They tend to go straight up, and then they're almost immediately cutting.
Mhm.
If they really want to go up and hold, then I think December is going to be really pivotal.
This brings up an interesting point that our conversations so much in the last 6 months or a year have all been macro. It's all been Fed. Is that the biggest driving force? How do you be an individual stock picker? How do you actually look at balance sheets? Who has debt, who hasn't? Or does it really just depend on what the Fed is doing?
I think this is macro is incredibly important. I would just one thing on what was said earlier, what Dan said, is that I do think for some, what's different about this cycle is that there is a structural story behind some value sectors. So energy, and to some extent, materials and industrials. I think, energy prices have become a bit detached from fundamental, but I don't think it's the same because of the underinvestment in CapEx, and the need to, I just think CapEx is actually, it's the bits versus bytes story. And I think this is going to be a bit opportunity. And so if you think of what needs to happen in terms of rebuilding capital stock, and I think that is both a macro and a fundamental story, rebuilding the capital stock, both in terms of housing, non-durable manufacturing, energy security, and, if you think of Europe, which I think is, once there is some sort of visibility with respect to energy security, a tremendous opportunity. The euro is trading below what it was trading at the depths of the European debt crisis. If you kind of pause to think about that, and Europe, their growth index is, whereas ours is dominated by tech and consumer discretionary, their growth index is more an industrials story. And so I think that it will be, finding durable growth models, durable balance sheet models, but also sectors, companies that for whom those macro broader thematic trends are at their back.
Talked about the different weightings, the US being a little bit more towards growthier, Europe being tilted more towards value. Does that then change the way you think geographically where you do want to invest, especially right now with some of the macro headwinds that we have been talking about with Europe?
So we're not top-down investors, we're bottoms-up stock pickers. Our international and global teams are growth-oriented. And I totally agree with Tina, by the way. I mean, I would say within the value sectors, traditionally, the one area that is really interesting to us now is energy and materials in general. And we do think that's actually returning to essentially the structural growth after years of underinvestment. But we apply the same approach in Europe. However, I think we're not very optimistic about, not only the European economies, but the position of a lot of their industries. And part of that is because they have much less flexibility than we do, just regulations, labor laws. They are burdened by, some of them are burdened by Brexit still. So, England is no longer part of Europe. Switzerland never really was. And obviously the geopolitical conflict there. So I think it's a very, very difficult scenario. And the energy problem is going to overwhelm many industries in Europe. Obviously, they're not going to be competitive on any kind of global scale based on their energy costs until they fix the energy. Now, there'll be opportunities to invest in Europe's reorientation of their energy, and we love those opportunities. Right. Yeah, we love those opportunities.
And I like that we're talking about energy as a growth panel, but that sort of brings up a good theme of the way we think about growth. Are you reevaluating how you define growth? What is growth? I know coming out of COVID, it was the safe haven of Apple and Microsoft, a steady cash flow, a good balance sheet. Are you now rethinking what is or is not growth to you?
No, I mean, I've always thought of growth as, growth is a persistent story. Value is a mean reversion story.
Hmm?
That you have to believe that your sales projections, your earnings projections, etc., will persist or be better. And so, how you pay for that are matters of degrees, right? Whereas value, you have to believe something will change to get to whatever its long-term trend. The thing that so growth is, I don't think of growth, obviously, with business cycles, the cost of that your people are willing to pay for those long-term projections changes. And the big thing that impacts its change is interest rates because they're long duration assets. But I don't think of growth as having changed. Value is a different story.
Mhm.
That's not your question.
Is growth still what growth was to you a few years ago?
Well, so for us, it's different. I mean, Alger is a growth boutique.
Mhm.
It's our sole focus. So we don't do value investing and we don't do top-down allocation. And so nothing has changed. Our philosophy, founded in 1964, our philosophy under Fred Alger, who I'm sure some of you have heard of, is still we look for the market sectors with what we call high units volume growth, strongest secular growth trends.
Mhm.
And then we look for the companies that are leaders, innovators, disruptors in those areas. And of course, the stocks, we have to judge what they're worth. But that's one target of our investment philosophy. The other part of our target, which is where energy comes in, is something that we call life cycle change. And we're essentially looking for companies or industries that have been in decline, commoditized, poor management, et cetera, but have a path to a multi-year growth renaissance. And in some cases, it's very individual. It's the company, new management fixing it. We're watching, for example, Intel closely, although we have no position in Intel currently. A great example of a turnaround that will be interesting to engineer. But energy is an example of our life cycle change. We've actually been probably net short, and we have been net short energy for most of the last 5 years, including in 2020 when it was spectacularly successful. But we are seeing, of course, now, and it wasn't just Ukraine-Russia war, it's just sort of the washing out of now. I mean, the energy sector is highly cyclical, but now there's a new driver. The new driver will be Europe reorienting, LNG, and we have a new position as America. I mean, we're energy exporters, and so we look for that growth renaissance. And the other sector we think is very interesting is that as you would imagine, our energy exposure traditionally has mostly been renewables, solar, wind, the growth sectors. We still like those sectors very much. I think the ones that are emerging, though, or emerged, are obviously often driven by consumer products like electric vehicles. So lithium and that supply chain is very interesting. And of course, the battery, I think the biggest investment opportunity out there, but no one seems to have solved it. But when it does, everyone will hear of it, is batteries. Because batteries, not only for EVs, but for backup power from solar and wind that doesn't operate consistently, can be completely game changing for
storage,
many industries. Yes.
Do we have any questions? I want to make sure that the audience is getting the answers as well that they want. Okay, keep raising your hand. Yeah, in the back.
Scott Carlson, Brown Advisory. You mentioned your Dan, your global and international teams. We've mentioned the Ukraine-Russia war. My friends in Europe are kind of moving these days from a possibility to a probability that the war could, spread west. How does that impact your perspective on your growth companies and energy?
Well, for energy, it's bullish. creates even more urgency to developing more diversified resources. It puts the U.S. in a relatively stronger position as an economy versus energy reliant, countries. As to the moving west, I guess what I'll give is the one anecdote from our international team, which is to remember, even as the news headlines could potentially get so much more horrible, but there's a company called EPAM. They are based in the Ukraine and in Belarus, unbelievably, a huge part of they have global operations, but a huge part of their workforce is there. They are IT services, so they do computer software development, programming, consultancy work for companies across the globe. As you can imagine, when the war hit, they were incredibly hard hit. Stock market immediately assumed, oh my gosh, everything is just going to be gone here. The team was really good at actually saying, this management team, the way they operate, using remote work, using the best technology, they're going to have some disruption, but it's going to be a lot less. And by no means is this company going away. And so far, they appear to have been right. This company is doing an incredible job with its teams. And it's also a sign that, yes, Belarus, we know, supported the invasion, right? It's a sign that, like, this, like many wars, unfortunately, it's being conducted for and by like a very small part of the population. There's a clear large population that wants nothing to do with this, wants nothing but to get along in their world. But so I think that's what would happen, right? Yes, the stock market will sell off for sure, but companies, just like in recession, actually, the pressure to innovate, to be efficient, to be flexible and adapt will always be there. And the companies that do that the best, of course, know that they will have a better chance of, getting through the crisis. And the companies that we like to invest in are the ones who, supply the products and services to enable that. And it's not all technology. A lot of it is, but a lot of it is, of course, is technology oriented. So
let me draw a little bit on what you said. One of the reasons, first of all, if you look at storage of LNG in Europe, it's actually at the same level as it was almost pre-war. So I don't know if no, obviously, if the war metastasizes and really goes west, everything that I'm about to say, just throw it out the window. I don't think of that as a base case, but I'll give you that. But I actually quite think that the horror stories about, Europe and energy shortage going into the winter are a bit overblown. So assuming, again, there isn't, an expansion. The other thing I'd say is going back to European industrials, companies, if you look at European and American industrial companies, American companies have had an energy advantage for many years, for decades. But in terms of their export and their competitiveness, take out tech, obviously. I don't know if American companies have translated that energy advantage to actually be more efficient than their European counterparts. And so I kind of think of, the old whatever wise tale, necessity is the mother of invention. And I think that out of this, energy crisis, that the really transformative industrial processes and ideas will actually likely come out of Europe. Now, that doesn't mean you jump in right now, because it is too, the geopolitical landscape is too uncertain. So you would need to see some resolution of the energy crisis, obviously. But I actually think that that is where the opportunity, this was the American decade. I actually think once that has been resolved, it will be the European decade. I know that's a little controversial. Sorry.
Questions. I'm not sure if I'm allowed to ask, but
Ooh, let's try one to start.
Just
I
one.
think we
Yeah.
only have a few minutes
okay.
left.
So we're in a growth panel. Your take on China and where we are. If it's, you think it's bottoming or it's, can I go to the second one or?
Do you want to answer China
You can
first?
answer
Yeah,
that
and we'll
quickly.
get back to you for
Yeah, you go
sure.
ahead.
Look, China they can't get their private sector going, right? Because it's overladen with property debt. And so you were not going to see a redux of 2009. I'm not a stock picker, so my friend over here will give you the stock story. But I don't see China as being the engine of growth as it has been in prior recoveries. And then on an individual security level or asset level, I think that the political and governance story is still a bit uncertain.
So I guess from the pure stock picker point of view, it seems extremely clear to us that any sign of reopening or return to growth, stimulative policies that are actually taking place in China as opposed to these COVID laws is gonna provoke a pretty significant stock rally. And it will literally be no change in earnings estimates or growth or anything like that, but probably worth 30%, my guess. And you can see that, for example, again, this is stock pickers. We were watching Macau casino stocks. A little announcement that they would allow people to go back to Macau. If you looked at actually the announcement, the restrictions on going were still pretty stringent, right? But the stocks were up like 15% in a single day and certainly would have continued to rally if China hadn't changed its mind like literally 36 hours later and said, we're shutting down again. So I agree with the economic analysis here. I think as a stock picker, if you can handle that kind of volatility, literally up 14% in a day and then down, giving that all up, right? And you'll be down 15% net 4 days later. It is a sign, though, obviously, that in some part that stock market is extremely pessimistic and bottomed and will rally a lot on, some progress there.
We're closing in on end of time. Any sort of other final questions? Yeah, or back there? Yeah.
I just want to hear their thoughts on the Fed pivot that we are talking about. Any views on that?
To pivot or not
pivot.
to pivot
Well,
from the Fed?
I'll just say very quickly, I think what I was trying to indicate was, I don't think there'll be enough negative data points between now and November for anything to happen in November. But I think by December, there might be enough for more signs that at least some of the governors on the board are sort of like, hey, we need to, if we're really going to go up and then hold, because remember, they're saying that they're going to get to 4, basically, 4.25, right? 4.4 by year end early next year. That for many people, that would probably be the right place to pause, I think. So that's my view on the potential for a pivot and why I think, for example, as I said, I think you could see stock market will bottom long before the recession ends. And probably, the recession will end before NIBR declares it was a recession, right? You know how this all works. The declaration of a recession is almost useless. I think, by the way, we're in recession now. So there's a good chance with the stock market likely to bottom before that. It's really the rally is 2023. And that's partially because it's hard to rally in December or year end, but I think you could see some very interesting stuff between December and January. And I know that's not super bearish. We have a more bearish scenario that's like, no, they're going to have to go to 5%. And, we're not talking about anything good until 1 year from now.
Do you see a Fed pivot or no?
I do see a Fed pause. But my big fear is if you think of the 70s, there was a pause. Then there was a big ratcheting up because inflation had not been slayed, right? I see that scenario. So I kind of see it as a 3-part play. and we're in the first act. The second act is a pause, and then the third is kind of another round of tightening.
We're way over time. We need another hour. I feel like we got 3 questions in and they were macro and energy in our growth panel, but
Right.
we'll have to have you
I'll
all
just say
back
healthcare
soon.
panel.